So now I'm going to talk about revenue recognition in ASC 606, when and how to count the money you earn. Today we tackle revenue recognition. Those constitute the accounting rules that determine when and how companies record the revenues that drive their financial results. Revenue is a top line. It's a starting point from which everything else flows. And you get revenue recognition wrong and your entire financial picture then gets distorted. Investors, analysts, and regulators, they scrutinize revenue more intensely than almost any other line item, and for good reason. Revenue manipulation has been at the heart of numerous corporate scandals. So the governing standard in the United States right now is ASC 606, which stands for Accounting Standards Codification Topic 606. And this standard is developed jointly with international accounting bodies, represents a fundamental rethinking of how revenue should be recognized. It replaced a patchwork of industry-specific rules with a single principles-based framework applicable to virtually all contracts with customers. So let me begin with the core principle of ASC 606. Revenue should be recognized to depict the transfer of promised goods or services to customers in an amount that reflects the consideration the company expects to be entitled to in exchange for those goods or services. So this is a mouthful. This principle sounds abstract, but it captures something intuitive. You should recognize revenue when you have actually earned it by delivering what you promised. That's that simple. So the standard provides a 5-step model. The 5-step model is used for applying this principle. Now, while the details can become quite complex, the basic framework is logical and learnable. So let me walk you through each of these steps. The first step in ASC 606, identify the contract with a customer. A contract is nothing but an agreement between two or more parties that creates enforceable rights and obligations. It can be written, it can be oral, it can be implied by customary business practices. For a contract to exist under ASC 606, several criteria must be met. The parties must have approved the contract and be committed to their obligations. Each party's rights regarding the goods or services must be identifiable. The payment terms must be identifiable. The contracts must have a commercial substance. And it must be probable that the company will collect the consideration it's entitled to. Now, the last criterion, probability of collection, is important. If you are not reasonably certain you will get paid, you should not recognize the revenue. And so this prevents the companies from booking sales to customers who are unlikely to pay, only to reverse them later as bad debts. Step 2 is to identify the performance obligations in the contract. A performance obligation is a promise to transfer a distinct good or service to the customer. And many contracts, they contain multiple performance obligations. A software company, it might promise to deliver software. It might promise to provide installation services and other ongoing technical support. And each of these could be a separate performance obligation. And they could all be distinct, meaning that the customer can benefit from it on its own or together with other readily available resources. Identifying those performance obligations correctly is crucial because revenue is recognized as each obligation is satisfied. If you bundle everything into one obligation, you recognize revenue all at once when the bundle is delivered. If you identify multiple obligations, you are allocating revenue among them and you are recognizing each portion as that obligation is satisfied. So the difference in timing can be substantial. Step 3 is determining the transaction price, the amount of consideration that the company expects to receive in exchange for transferring the goods or services. Now, this sounds simple, right? But it can involve significant judgment. The transaction price may include things like variable consideration, amounts that depend on the future events such as discounts, rebates, refunds, bonuses, maybe penalties. It may also include financing components. If the timing of payments, they differ substantially from the timing of delivery, it may include non-cash consideration whose fair value must be estimated. So when transaction price includes variable elements, you must estimate the amount you expect to receive, and the standard permits two approaches. There is the expected value method, which is commonly used, which weights the various possible outcomes by their probabilities, and the most likely amount method, which uses the most likely outcome. Whichever approach you use, you can only include amounts in the transaction price to the extent it is probable that a significant reversal will not occur, and where uncertainty is largely resolved. Now, the constraint on variable consideration is designed to prevent aggressive revenue recognition. A company cannot book the maximum possible outcome and then reverse it later. It must constrain its estimates to amounts that are sufficiently certain. So step 4 is allocating the transaction price to the performance obligations. If a contract has multiple performance obligations, you must divide the total transaction price, and you have to divide the total transaction price among them based on their relative standalone selling prices. So the standalone selling price is the price at which you would sell the good or service separately. Sometimes the standalone selling prices are directly observable. You are actually selling the items separately and you know the price point. But other times you must estimate. Now, acceptable estimation approaches include adjusted market assessment, which looks at prices competitors will charge for similar items. Expected cost plus margin, which estimates costs and adds an appropriate margin. And the residual approach. And that is kind of limited in approach, but is used in limited circumstances when standalone price is highly variable or uncertain. So step 5 is recognizing the revenue when or as performance obligations are satisfied. A performance obligation is satisfied when the customer obtains control of the promised good or service. Control means the ability to direct the use of and obtain substantially all the remaining benefits from the assets. Performance obligations can be satisfied at a point in time, or over time. A point in time obligation is satisfied at a specific moment when the product is shipping, when the customer takes delivery, when the installation is complete. That's point in time. On the other hand, you can have overtime obligations. It is satisfied gradually as work progresses. For example, construction project. It might take 18 months, a service contract that provides benefits continuously. So the standard specifies criteria for determining whether a performance obligation is satisfied over time. If any of these criteria are met, revenue is recognized over time using a measure of progress toward completion. On the other hand, if none are met, revenue is recognized at the point in time when control has transferred. So let me illustrate how this framework applies in practice with some common scenarios. Consider a simple product sale. A customer, they order goods, you ship them, they pay upon receipt, the contract is a purchase order, the performance obligation is delivering the goods, the transaction price is the order amount. And since there's only one obligation in this particular case and no allocation is needed, revenue is recognized when the control has transferred. Typically when the goods are delivered or when the risk of loss is passed completely to the customer depending on the shipping terms. Now, imagine a software company that sells a license implementation services, a 2-year support contract for a total price. Now things get a little bit dodgy. You must determine whether these are distinct performance obligations. Is this software license? Is it distinct? If the customer can use it without implementation, implementation might be distinct if it does not significantly customize the software. Is support typically distinct? Now, if you are able to determine that the 3 obligations are distinct, you can allocate the total purchase price based on those standalone selling prices. But perhaps a license would sell for 60% of the value, implementation for 20, and support for 20. Revenue for the license is recognized when the software is delivered. Implementation revenue is recognized as services are being rendered over a period of time. On the other hand, support revenue is recognized ratably over the 2-year support period as well. So consider a construction company with a long-term contract in this case to build a facility. The contract likely meets the criteria for overtime recognition, right? Why? Because the customer is controlling the asset as it is created. The revenue is being recognized progressively as the construction advances using either an input method based on costs incurred or an output method based on milestones achieved. And the choice of method should reflect the pattern in which the company transfers control to the customer. I want to be able to address some of the areas that commonly require significant judgment. Contract modifications, changes in scope, changes in price, or both. After a contract begins, it requires careful analysis. And it depends on the nature of the modification. It may be accounted for as a separate contract and sometimes, or a termination of the old contract, or a completely new one, or an adjustment to an existing contract, an extension. Principal versus agent considerations arise also. When another party is involved in providing goods or services to the customer, are you the principal? Are you controlling the goods before they transfer to the customer? Are you an agent arranging for another party to provide the goods? Principals recognize revenue at a gross amount collected. Agents are recognizing only their fee or commission. So this determination can significantly impact reported revenue. Licenses of intellectual property, that's a specific condition. It requires analysis of whether the license, it grants a right to use intellectual property as it exists at a point of time, or is it a right to access intellectual property as it exists throughout the license period. And so this determines whether revenue is recognized at inception or over time. You see where things are going with this? Bill and hold arrangements where a customer's bill but delivery is deferred at their request, that has specific guidance as well. And that criteria must be met before the revenue can be recognized. The customer must have requested the arrangement. There must be a substantive reason for it. The product must be separately identified as belonging to the customer, and the product must be ready for transfer. So these are the complexities, if you will, of ASC 606, and guess what? I've covered a lot of ASC 606 videos in my channel. But this is more of an overall framework. The most important thing is to understand the intent and look at things from a customer perspective. That is what ASC 606 is driven by, customer perspective. And then look at those 5 principles, and once you understand the 5 principles and understand various use cases associated with each and every one of those line items, ASC 606 is not as complex as it tends to be, or people think of it as being. It's pretty straightforward. So I wish you good luck on the journey of understanding the ASC 606. It's a very important standard, and it's a very cited standard, and a lot of operations are based around it. So, read more white papers on ASC 606. And like I said, I have a lot more video sessions. If you have any questions or comments, feel free to add some notes. Thank you for your time, and I'll see you in the next session. Take care. Bye-bye.